All right. Welcome back to the Casual Friday broadcast. I think that's what we're calling it, Steve.
Yep.
I'm
I'm dressed.
That's right. That's right. I'm joined today by Steve Jolly, who's a partner, financial advisor, and an accredited fiduciary in our office. My name is Brian Ullman. I'm a partner, financial advisor, and fiduciary also in our office. And today, Steve and I have 4 charts for everybody, so we can kind of chat about how things are going, how things have gone in markets this week, and talk a little bit about kind of some of the charts that we found interesting. Steve, my first question for you, because you are in Truckee right now, as you can see from your sign behind you.
Yeah, correct.
Did you feel the earthquake yesterday?
Oh yeah, last night. We had one, I think it was about a week ago, that was just boom, real quick. I think it measured around 4.2 or something like that. And last night's was a little louder and a little longer and a little more scary.
Yeah.
Measured near the 5.0 somewhere on the scale.
Oh, really? See, I got an alert on my phone. It says the earthquake in Northern California. So I checked it to see where it was, and it said it was near Truckee. So I thought you might have felt it if it was big enough.
Oh yeah, sure did.
Oh,
yeah.
Really? Well,
and when they're going on, it's, not like in California, not like we feel them all the time, but when it's going on, you're like, boy, let's hope the house doesn't come down. And then when it's over, you're like, oh, that's kind of cool. So
a bit of a roller coaster ride.
And a cool phase right now because we haven't had many aftershocks that I felt.
I'll be honest with you. I didn't know that you got earthquakes up there.
I didn't either. And since we're talking financial stuff, it made me think in the last 2 weeks, I may have to check into the
earthquake insurance. Yeah.
That's right. Down in Fresno, I think that, we are not really near a fault line. And I think all the sand and stuff, we don't get quite as much movement.
Well, I from my understanding in Fresno, our biggest natural threat is actually a volcano that's southeast of here.
Yeah.
Believe it or not.
Probably. Yeah.
Yeah. So earthquake, flood, wildfire. I mean, there are plenty of other places in California that suffer all those things. Not Fresno.
After 2021, I'm not counting anything. Or
nope,
after 2020, I'm not counting anything out. So.
Absolutely, you cannot count anything out. Well, I'll tell you what. Markets kind of had an up or down week depending on which side you were standing on. It looks like
the Nasdaq intraday. A couple of the days, the market was down and then up.
Yep.
And so there was a bit of volatility this week.
No doubt. It feels like the market is sorting out right now in real time where we are, where we stand with reopening and COVID. We're reopening, but a lot of the jobs that were lost are having trouble being filled. We have the jobs report today, really disappointed. So it's been interesting to see, for the week, the Russell 2000, which are small caps, and the NASDAQ, which tends to be the tech heavy names, were down, whereas the Dow and the S&P 500 were up. The Dow was up quite a bit, S&P up a little bit. So kind of an interesting week.
What I've noticed, like in this market, not just this week, but maybe in the last month or two, is this market shows signs of changing not so much direction, but leadership. Right. Over 2020, of course, with folks staying and working at home, all those technology names, were at the forefront. And with interest rates at 0, I won't go into discounted cash flow modeling, right. But when the risk-free rate is at 0, people are willing to pay up for growth.
Right. The old Tina trade, right?
Yeah. And so they did. And the growth had been found in the technology names. And now we may be transitioning out of that period where we might get a new leadership. And I think that's what this week's numbers at least show, with some of those higher growth names being down.
Yeah.
And some of your more stable, dividend payers, lower growth, a little bit more boring, maybe a little more economic sensitivity to some of these names. But as we move out of the pandemic, knock on wood, we might see this shift away from leadership of high growth names, technology, into perhaps some of the more industrials.
Well, it was an interesting kind of disconnect, because it's almost like tech tech names were good last year for two reasons. One is because we were all using more and more of our technology. We were all watching Netflix and checking our phones because we were locked in our houses. One, and then two, I think for especially like the big, I won't use the names, but the largest mega cap tech names, they were almost treated like maybe GE or GM were treated 50 years ago. It was like, yeah, it was like an Apple we trust. And so it was not just a growth play because of the pandemic. It was also a defensive play at the same time. It's really weird, but you're right. Now that they've had this run up so much over the last year or maybe even more, now as we start to reopen and we drive around more and travel and interest rates may go up, we have these different other sectors kind of taking control.
A lot of things going on in the financial world. Not to belabor or beat a dead horse, as they say. Yeah. Sorry, Peter, I didn't mean that.
Yeah,
literally. There might be some change. So, and change brings, uncertainty, and uncertainty brings volatility. And so that goes back to what we opened with is we saw a little bit of that volatility, and underneath it might be a changing of the guard.
Yep. Yeah.
Which is healthy, actually.
It's okay. Yeah. I mean, we might be in for a bumpy summer, but I don't think anything like we experienced last summer.
Yeah, I would not think so.
Let's get into the charts a little bit. I think I'll go first here. Mm-hmm. And you can kind of see these are just a couple of things that last week I talked about the whole sell in May and go away kind of phenomenon. And those charts kind of the two charts I brought to the table kind of were working in that thing. These I just simply found interesting. One, this comes from JP Morgan Asset Management, which we work with often. And this is a breakdown of your probability of living to a specific age if you're 65 today. And the reason I found it interesting is because we run a lot of financial plans for people. And there's always this question of people either think they're going to live way longer than they actually will, or the more dangerous thing is they think they're going to die a lot sooner than they actually probably will. And so you can see here, the purple column is women, the gray column is men, and then the green column are couples where at least one of them is going to live to a specified age. And you can see the odds are about 20% that if you're married at 65, you will live to a 20% chance that one of you is going to live to age 95. And that means you need to plan for your finances to go to age 95. And that's what I think we run our plans to here. Just as interesting, though, is that you have about 50% chance that one of you is going to live to 90. This is a lot longer than I think people realize. And even if you go, the real interesting part is if you see that little box kind of in the middle, the average life expectancy at age 55 in 1990, and then in 2019, and then 2090 there. You can see that the life expectancy is going up and up and up. So women in 1990 were living to 84. Then 2 years ago was 85 and a half. In 2090, the average life expectancy for women will be almost 90 years old. That's pretty wild. And the difference also is narrowing between men and women. Generally, was it 30 years ago? I guess now women were living 4 years longer than men. Now it's 2.5, and it's expected to kind of continue to narrow to about 2 years difference. And so I think a lot of people are
due to healthcare changes, and also, I'm not going down an elevator shaft into a coal mine every day.
Absolutely. A lot more service jobs and less manufacturing that could put people at risk. Not many people smoke anymore. We understand dietary stuff, maybe a little bit better. I mean, we all eat too much fast food. Yeah. We all eat too much fast food and drink too much and stuff. I get all of that. But generally, our health habits and our health awareness have improved to the point where we're living longer. And I think this is really interesting from a planning perspective, that you really do need to plan to live longer than maybe you thought you did.
And another way that I have insight to bring to that is you may actually live in retirement very close to, if not more, than the years you worked.
Yeah, like a third of your life could be in retirement, which is
correct.
Wild to think of. So I found that one interesting. And I always love kind of those those stats that show us kind of how things are changing over the years. I have one more. Let me work my technical magic over here to see if I can get my other slide up. I have one more here. There's a lot of talk about inflation, and so we were talking about longevity just a second ago and how people are living longer and over 90 years. Well, this is over the last 100 or so years, the purchasing power of a dollar, where there's so much worry. This comes from the Visual Capitalist. And they've taken it from the Bureau of Labor Statistics. And it's the purchasing power of a dollar over the last century. And it shows that we have always grappled with inflation over the years. And right kind of in the middle, it says the gold standard is abandoned and currencies are no longer linked to gold. That was when Nixon left the gold standard. And you can see we started dropping pretty precipitously. But the purchasing power of the dollar, once we got to about 1980, started to level off a little bit. But the thing that I found most interesting about this chart was that, however, you can see over the years what a dollar could buy you, a $20 could buy you. So a dollar could buy, now it would have, a McDonald's coffee is $1. And it would cost you now $1.20 to buy 2 lemons from 10 years ago, and 4 grapefruits from 20 years ago. And so it would be $26 in today's money to buy 30 Hershey's chocolate bars back in 1913. You'll see on the bottom. I think the point here is that inflation really has always been with us. And as the economy grows, it probably always will be with us to varying degrees. But we've also, and we'll see in some of your charts, Steve, despite the purchasing power of the dollar eroding over the years, we've all done okay and have been okay and will continue to be okay, even though we get some inflation from the dollar. I would say also there is this idea that stashing a bunch of money in savings is okay. It's important to remember the most basic tenet of investing is that you're trying to maintain the purchasing power of your money, right? At base level, you're supposed to keep up with inflation. And if we are starting to get some more inflation and things like a savings account or a CD isn't keeping up with inflation, your purchasing power, like we're seeing right here, is eroding because your money is sitting kind of gathering dust in a savings account. And so you need to work to do some things so your money can inflate and you can keep that same purchasing power over time. So,
Brian, I kind of have joked throughout the years that, putting long-term and you need savings, short-term rainy day money, 6 months, 9 months, a year's worth of emergency cash. But you never want to take long-term investment money and park it in a bank savings, especially today because the rates are nil.
Right.
And I always joke that that's the safest way I know to lose money.
Right.
And you're still, a dollar's still going to be a dollar. You're going to have that dollar, but instead of buying a gallon of milk 10 years from now, it's going to buy a quart.
Well, absolutely. Look at the dead center in the right, kind of in the bottom, in the middle of this. You can see a one drive-in movie ticket in 1964 would have cost you $1. And today it costs you $8.35.
When you can find a drive-in theater.
If you can find a drive-in theater. I miss the drive-ins. Or a sack of oranges would cost you $1. Now it costs you almost $6.50. That's exactly what you're talking about. How that gallon of milk or a gallon of gas, it's gonna cost you more. And that purchasing power, if it's $1 sitting in a savings account for 20 years, you will not buy as much. You just won't. And so it's important to stay, for those reasons, invested. And also, just like the last slide we saw, you need to stay invested because you're going to live a lot longer than you maybe think that you were going to otherwise. I also found it interesting with that first slide that if you're married, you live longer. You hear all the jokes, right? They're easy jokes to make. Oh, my husband's going to kill me. My wife's going to kill me. But not true. Not true. You're going to live longer, whether you know it or not. Or so one of the two of you is, I guess.
Well, I married a wife who's 7 years older. I thought I was getting in front of that. So
no, yeah. Well, we'll see.
The spread narrows. I don't know.
Yeah.
Means, so
you both are going to live longer.
I love you, Tracy, but let's,
yeah, you're live right now.
Yeah.
All right. So let's move on to your charts, Steve.
Yeah.
I think you found a really cool scatter plot here that I think people are going to like. This is the S&P 500 annual returns. Tell us a little bit about what you found interesting on this one.
One, it looks like I took a blank piece of paper and went out in the field and shot that paper with the shotgun.
Buckshot, yep.
Buckshot, and this would be the scattergram that shows. But what this is this is the yearly annual returns since 1926, which is when they started recording the numbers for the S&P 500.
Yep.
And so it just shows every year, year over year, what the actual return was. And Brian, when we going back to your charts about life expectancy being longer and the threat of inflation taking away purchasing power, we as investors are like, okay, I understand that now.
Yeah.
That means I need to invest my money. I can't just park it in a savings account because the risk-free return is less than the inflation rate. And if I'm going to live longer, I can't afford to just park it. And so so then we look to invest in perhaps stocks and bonds. And again, this is a stock index scattergram.
Right.
But sometimes the rationale or folks are afraid to invest in stocks because they hear about risk. And this chart maybe illustrates a little bit of that. The return, unlike a savings account where you're going to get X percent every year, and the growth, even though the growth may be less than the inflation rate, each year you're going to see it grow in a flat line.
Right.
Whereas but you don't get rewarded unless you take some risk, and that's very apparent in today's world. Yep. With risk-free rates being pegged, almost at zero, and so we know we have to take some risk for to kind of to counteract that longevity and purchasing power risk we talked about earlier.
Right.
And then if we could translate or move to the next slide.
Yeah. As we move on, I'll say the thing that strikes me about this one, there are more dots above the line than below the line.
There definitely are.
And and many of the dots below the line are pre-1980.
Correct.
And so
but there are dots below the line.
No doubt. 2008 is in there as well.
Now, we as investors and even, you and I and folks in our industry, we might be doing the investing public sometimes a disservice. For example, when we look at the average return on that previous chart, it wasn't on the chart, so we don't need to go back. But the average return since 1926 for the S&P 500 has been real close to about 10% a year. And so when you and I sit down with clients and we're like, well, what can we expect from equities over the long term, not day to day, and then we'll get into that, but in the longer term, if we say 10% roughly, that's what it's been on average. Past performance is not a guarantee of future.
Yeah, all that stuff. Can't tell you. Right.
So our clients will leave the office and go, oh, okay, I'll see that 10% on average on my statement. Oh, you will. But the thing about averages is it takes a lot of different data points to create that average.
Yeah.
And when you get into the minutia of that data, it's not a straight line.
Yeah, you've got to earn that 10%.
You got to earn that 10%, and that's why any advisor worth their salt will say, "How long can you put this money away for?" Because if it's nest egg money, you can't afford to have it be down when your air conditioner breaks.
Absolutely.
And the car goes kaput.
I tell people, do you think you're going to need it in the next 2 years? If so, that's different than whatever your long-term retirement money is.
Correct. So if we're talking about longer term goals, retirement, et cetera, education, then, equities, and again, just this might sound simplistic, but we talk about stocks and bonds, and sometimes maybe it's good to get a little clarification on what that means. A stock means you're an owner in the company. You have stock. Right. If a bond is when you are lending a government or an entity money. In a bond, you have the promise to be paid back with interest, a little safer.
Yep.
As opposed to if you're an owner in a company, you're going to get paid back only if the company does well, either through dividends or capital appreciation. So there's more risk. Because there's more risk, historically stocks have done better, but that comes with volatility.
Well, that's kind of where this chart comes in, right? This is a chart from the JP Morgan Guide to the Markets and is one of my favorites. It's one of my absolute favorites that you chose.
And we're not shills for JP Morgan. They're just one firm that, whose investment products are available to us. But man, they do put out a quarterly report that has charts like this in it.
Yeah, and they're great. The charts are great. The charts are great. Yeah.
And what this page is showing us is that going back to 1980, so now we're talking about 41 years, still a lot of data points.
Yeah.
And the key takeaway here is, and Brian, you mentioned on the previous chart, there's not that many years where the market actually finished negative. And on this chart, we can see that there are 1, 2, 3, 4, 7 years, and that's it depicted in the dark gray. There's 7 years where the market actually finished negative. So only 7. So 31. I'm sorry, there's a couple smaller ones in there. So 31 out of 41 years, the market finished above the 0% line, positive.
Right.
So, those are good odds.
No doubt.
However, that's not a straight line, as I alluded to. So you do have to experience some down years to experience more of those up years. But my key takeaway from this is 2 things. One, there is volatility when you invest in equities. We need to have time to get more of those up years than down years. But we have to know that, and here's where it goes back to the disservice that I mentioned earlier. If we say an investor might expect an equity return of, let's say, 8 to 10% a year, it's not going to be consistent. It's an average of 8 to 10% a year. And the red dots with the numbers next to them in the negative on this chart, it shows the maximum drawdown, the maximum drop in any given year.
And there's a red dot in every single one of them.
There is a red dot.
There's a drawdown every year, right?
And it's not the average decline intra-year is roughly around 10%. So if you're investing in stocks, and now we're talking about not diversified portfolio, we're talking 100% in stock.
Right.
There's tools that you and I and our financial advisors can use, diversification tools, bonds, gold,
smooth out this roller coaster. Right.
But if we're talking only stocks, you're going to expect a drawdown every year. It would be unusual not to.
Right.
But it's important, and that's where sometimes as a disservice I say, a client may leave going, oh, well then show me, I'm just going to sit back and collect my 8 to 10. And then when we get a decline intra-year, which we know is coming,
right.
That's when we turn into, we're our own worst enemy as investors.
Yeah.
Is selling when it's low, perhaps because we didn't expect it. And so we start to get panicked out.
Right.
Nerves fray.
Well, if anything, this chart just reinforces the fact that you need to keep your cool, because even you can look last year, the max drawdown was 34%, but the S&P finished up 16. And even in good years, 2019, everybody had a good year. Market was up. S&P was up 29%. It still had a 7% drop that caused people to grip pretty tightly. This is the long game that everybody's playing here. And this just reinforces that notion that it pays to keep your cool, right? When these red dots show up mid-year.
And that's true. And then, again, being that an advisor who may promise or indicate expected returns of equities between 8 and 10, I read somewhere that there was only 4 years out of the last since 1926 where the market actually earned between 8 to 10%.
Yeah, right.
So it's average above.
It's either above or below. That's how you get to an average, right?
And so as investors, as investment professionals, we have to make sure our clients are prepared that, hey, equities are going to get us there in the long run, but it's going to be a bit of a bumpy ride. And we know that. We're going to do things to help smooth it out. Putting alternative assets in there besides just 100% equity or stock. Mm-hmm. So anyway, I just thought this chart was interesting.
I think this is great. Like I said, this is one of my favorites. This is
it's my go-to chart in the book. And maybe because it's the only one I understand. Maybe I have to start learning the other ones.
We know that's not true, but yeah, this is certainly one of the best ones.
And especially in drawdowns, when we get periods of drawdowns, and I'm a human, and so when I see the market go down, it starts to get serious, at 5%, or more. Sometimes I have to, look at this chart and say, hey, been there, done that.
Yeah.
We'll get through.
And I think the longer you invest, it probably, I don't want to say it gets easier, but you understand a little bit that this is part of the deal, right? Part of the deal is that it doesn't go straight up. If your investments only go straight up, you're investing with Bernie Madoff.
Correct. Right.
They don't just go higher. That's it. That's all there is to it. There's risk that comes with the reward. So, and
that's part of the job of your financial advisors, are to help you when things do get. That's part of our value add is when things get bad, to talk and listen and
get some perspective.
To find some charts like this and others that show some perspective and to help us stay in the game. And if it's not an emergency and you don't need your funds, most of the time selling, out, especially like 100%, just get me out. That's such a binary decision. You're either wrong or right. It's nobody behind the market. It's time in the market.
Yeah. And the people who do clear it all out, I don't know if I've had one that's done that didn't regret it.
Yeah. And how do you know when to come back? Most of the time people then come back in when it's high because it feels good.
I still have someone waiting for Dow 18,000.
Right.
I don't think they're coming back.
I hope not. I doubt it.
Yeah. Me too.
I don't mean them. I mean, I hope the market.
I hope doubt it. Yeah. I doubt it either. But I guess if it is, then it's the world's best buying opportunity, right?
And you know what, man, hard to imagine getting a better buying opportunity than March, April of 2020 when the world stopped. For what we thought was going to be a 2-week. Let's stay at home and shelter.
Flatten the curve.
Let's do our part. And who would have thunk a year and 2 months later, I'm still working from home. And
not me.
The good news is working from home is possible and it's working.
Yep. Yeah. And in California, 50% of people have vaccines, have received at least one shot. So we're getting there.
On a side note too, just a little bit of housekeeping. I'm having 2 in-person in our office meetings on Monday and Tuesday down in Fresno. And so I'm opening back up. I'm vaccinated, both shots, and we're still going to take precautions, but
we're not going to be reckless, but it's nice to be back open for sure.
Yeah, and for our clients that are listening to this, hang in there. We're opening back up, and if you want in-person meetings, they're happening now.
Yeah,
so
absolutely.
And Zoom is still there, of course. Telephone.
Yeah, well, I think that's going to be part of some people prefer it. And so it's going to be part of the repertoire as we go forward. Do you want to talk on the phone? Do you want to do Zoom? Do you want to meet in person? And I think the thing that COVID has left us with is those kinds of choices now. I joke with some people, you can buy groceries online and have them put them in the back of your trunk. My wife's never taken the 2 kids to the grocery store ever again. Technology has scrubbed out some of these nuisances that we have in life. So we have a little bit more time to do the other stuff that's, I think we've come to appreciate more and more, which is in-person kind of stuff with people that we know and we like and are friends with. So, well, good. Well, we'll leave it there. Steve, thanks for jumping on. I think you picked a couple really, really good ones this week, and we'll have to do this again.
Yeah, I'll keep an eye open for more material. If we get some good stuff,
absolutely.
We'll jump on.
We'll do it again. And I'll say before we sign off, I will say if you found this interesting, I would encourage you to like our Facebook page if you're watching this on Facebook. I would also encourage you to follow us on YouTube or subscribe to us on YouTube because we post this video as well as other webinars and things that we do for clients on there. So you can check us out on either of those platforms. So, Steve, have a great rest of your Friday. Have a good weekend.
Great. You too, Brian. Wish your family well.
Thanks. Take care.
All right. Bye-bye.